Trump said that it's too late for talks with Iran. Reporters repeated it. News outlets flagged it globally. As its core, this is a signal, not just about war, but about economic risk, and how policy language moves capital fast than stock stickers. Informal comment here. Markets don't read policy papers. They read your headlines and price them instantly. So the question becomes, what does too late to talk actually mean economically? To answer that, we need the context. The United States and Israel have launched a major military campaign against Iran. Strikes have targeted military infrastructure. Leadership losses and defense capabilities have been reported. Trump framed much of this as elimination threats. And in that narrative, talks are portrayed as an option that was missed. Informal note. Linguistics matter here. Too late signals finality. Economically, uncertainty is priced into multiple sectors. First, energy markets. Iran sits near to Strait or Hormuz, a choke point for global oil shipments. When that road feels threatened, prices move. That is not speculation, it's real cost pressure. Oil traders consistently adjust future prices when risk skews higher, because even the possibility of interruptions rise the cost of capital. Higher oil prices ripple outward. Fuel costs rise. Transport costs rise. Consumer prices rise. And suddenly, inflation becomes sticky again. Informal observation. Even a whiff of conflict can push pumping prices higher before any barrels are disrupted. Supply chains present another dimension. Modern global manufacturing relies on fluid logistics. Everything from microchips to metal passes through complex networks. Conflict escalations make logistics managers nervous. Freight rates tick upward. Insurance premiums rise. Routes get longer. Fees increase. This may not show up immediately on GDP figures, but it shows in comparison and in costs. In a wage cost negotiation, that's because companies begin hedging against risk. They stockpile, they delay contracts, and they outsource away from danger zones. Informally, supply chains don't react to calm, they react to certainty about calm. Markets are forward looking, they don't wait for facts. They price expectation, and when diplomats say too late to talk, that sets the tone. Risk premiums widen. Equity markets become more volatile. Bonds may see safe haven inflows. Currencies can fluctuate as capital shifts. That's not speculation. That's how capital markets function. Informal note. Volatility is the price tag on uncertainty. Presidents don't speak in isolation. Their words shape investors' psychology. A definitive refusal to negotiate creates a sense of commitment to military strategy. But it also signals a lack of negotiation de-escalation. Investors price solutions as well as problems, and when diplomacy pathways seem closed, risk traders assign higher weight to worst-case scenarios. That doesn't mean markets crash immediately. It means markets hedge more aggressively. That is how financing works. Informal comment. Markets stretch closed doors like higher economy friction. Here's an important nuance. Farrell's report suggests Trump has also indicated willingness to talk under different conditions. He told a magazine interview that Iranian leaders appear interested in negotiations. He said they want to talk, and I have agreed to talk, but followed that the frustration about time. That is a subtle but important distinction. Official statements say talks are too late right now, but private interviews suggest talking is possible in principle. Informal. In diplomacy, phrasing is everything. Markets, however, respond to public policy positioning, not nuance. When leaders publicly downplay negotiation, risk appetite shrinks. The Middle East remains central to global energy supply. Iran, Iraq, Saudi Arabia, and Qatar all anchor pipelines and tankers. If combat expands, shipping insurance costs rise. Fuel prices price that early. When insurers see risk, premiums jump, and logistics manages added buffers. That increases cost structures globally. This is not speculative. It's a well-observed economic pattern. Informal comment. Logistics hates ambiguity more than tariffs. Heightened conflicts make trade negotiations harder. Countries may delay deals. Tariffs talks stall. Investment commitments get postponed. Trade historically slows during geopolitical tensions. Growth forecasts get trimmed. Export-oriented economies feel it first. Emerging markets feel it fast. That's because capital seeks lower risks, and geopolitics rises risk. Period. Informally, when diplomats shout too late, commerce whispers cautions. Risk isn't just financial, it's psychological. Consumers' confidence index reflects sentiment. When global conflict escalates, consumers tighten spending. Bigger tickets purchase get postponed. Travel budgets shrink. Housing markets can soften. This isn't fairy tale economics, it's measurable behavior. If confidence dips, GDP growth expectation adjusts downward. Informal note: conscious consumers are conscious economies. Energy price spikes feed into headline inflation. Central banks monitor this closely. If inflation rises, monetary authorities may tighten. Tighter policy can slow investment. Yes, geopolitical noise can become monetary action. Informal comment: central banks don't like surprises. Conflict triggers defense spending increases. Budgets get relocated. Infrastructure and social programs may be delayed. That changes fiscal trajectories. Fiscal shifts mean changes in tax policy discussions. Investors factor in future deficits. That's a real cost of policy choices, not a dramatic exaggeration, a measurable economic effect. Investors globally are relocating risk assets. Stocks with defense exports can rise. Energy stocks may spike. Travel and hospitality sectors can soften. Currency pairs adjust with risk sentiment. These are strategic shifts, not panics. Markets adapt to new information fast. Informal note: markets hate surprise but love clarity. One of the biggest clearest risk factors is duration. Trump also indicates operations could extend beyond project timelines. 4 to 5 weeks has been mentioned, but also far longer was flagged. Uncertainty's duration equals higher economy risk pricing, so duration becomes a central economy indicator, not just the conflict itself, not just the flighting, but how long markets price uncertainty. Informal comment: duration is the daily cost of conflict. Diplomacy can mitigate economic fallout. Even if whispers negotiations stabilize futures. But publicity declines too late dims that effect. That doesn't foreclose talks entirely. Private channels still exist, but public posture shapes market psychology broadly. Informal note: markets respond to message, not motive. If conflicts persist, global investment strategies may shift. Capital may seek safer havens. Infrastructure projects may slow. Long-term growth projections may be adjusted downward. Emerging economies are most vulnerable. They rely on stable trade flows, and geopolitical risk weigh heavily on bond yields. That affects borrowing costs. That affects development spending. Informal comment: global economies is a network. Disruption spider web outward. It's important to avoid fear. Reality is not panic. Reality is adjustment. Economies adapt. Markets absorb inflammation. They reprice expectations. They rebalance portfolios. That's not chaos. That's calculus. Informal note: finance is language, and economists are translators. One positive reality is this: clear statements reduce rumor. Rumor creates chaos. Even a firm "no talk for now" is clarity. Clarity lets markets hedge effectively. Hedge instruments stabilize outcomes. Investors can price risk more accurate. That's better than fog. Fog is pricing in nightmares. Diplomacy may yet resume. Military progress may open new channels. And if Iran and the US find a path to dialogue, markets will respond positively and instant. Markets always respond to certainty, not battles. That is an essential truth. And truth matters when billions are on the line. Informal note: investors are like careful chess players. They see moves ahead. And for now, the move being priced is continuing uncertainty. But uncertainty doesn't mean inevitability. It means adjustment. Adjustment leads to strategy. Strategy leads to stability. And stability is the ultimate goal of economic systems. So when leaders say too late, economists listen, markets reposition, businesses edge, households adjust expectations, and the world continues. Because uncertainty is not collapse, it's information. And information, when understood, becomes resilience. So tell me, what do you think about it?